Okay, good morning, everyone. Welcome to the second session in this annuity phase. And today we will discuss about FIA, that is fixed index or fixed indexed annuity. So, when we were covering about the fixed annuity, we talk about that the accumulation on the balance will be at a fixed rate of return, but that accumulation is quite less. Basically, you are getting a low rate of return. So then what happened was that a new product was launched, that was FIA, where we are saying that okay, you are going to get the full principal protection of your balance, but you will also get an exposure to the market based returns. So here the returns will be based on the external index, but the but there will be a limited potential for growth. So what we are trying to say, let's try to understand over here. We are talking about the fixed annuity. So what happen in case of fixed annuity, that it is going to provide you with the limited potential for growth based on the external index that we are trying to say. And there are a lot of different features in the FIA. So let's try to cover that step by step and see a lot of crazy things. So it is a long-term savings option that provides the principal protection in a down market and an opportunity for growth that will be linked to the market returns. Make sense? Simple. Next is the full principal protection of your balance that we are going to provide you. Like before I will move on further, let me explain that with the help of example. So in our last one we covered about the this one. Let's cover this. Same thing. Let's say that at the age of 40, person paid just $100,000, and the income payout phase will start from age 65 onwards. Now what happened? Premium was being paid. Okay. Then we are saying that you are going to get a return based on the external index. So now, in case of an external index, let's say, so we are saying the external index can be, let's say, S&P 500, Standard and Poor 500, Nasdaq 100, and all these different funds or different indexes. Let's say we are saying that whatever be the return of the S&P for that specific year, that return we will consider while accumulating the interest based on this balance. For example, we are saying that whatever be the return that will be generated by the S&P 500, as an insurer, I will provide you 80% of that gain. I will provide you 80% of that gain. So for example, the external base return is, let's say, 12%, 10%, 5%, 8%, let's say 8% for the next entire period. The interest accumulation will be on the 80% of this return that will be generated by the S&P 500. Basically this into this. So this will be the return that will be accumulated on this balance, right? So what will be the value at the end of period? That will be this balance into 1 plus I, this. And then this into 1 plus. So this will be the value, $500,000 that will be given. Make sense? So that is what we are trying to say. But the index can be this one, or it can be a multiple combination of indexes as well. So it depends upon a product to product. That is just the basic that I have just created over here. But let's try to take a look at the different features and different crediting strategies over here, and it will be so much fun to understand. Let's begin. So again, it is going to provide you with the full principal protection, which makes sense because what we are trying to say is full principal protection. Let's say in this year the return is minus 5%. So what happened in this case? Your return has been, your value has been decreased, right? So which means that this formula is not correct. So what I will do is I will apply the max condition that either this or zero. So now you see, I am providing you with the full principal protection. So if there comes the year in which the index has given a negative rate of return, you are going to get a full principal protection. So you don't have to worry. Your balance will remain intact. So you are going to get a full principal protection. That is what we are trying to say. The interest crediting occurs on a point to point PTP, point to point basis. It refers to change in index rates at two pre-selected points in time. So let's understand what we are saying. For example, on 1st January, the person bought this policy. Okay. On 1st January, person bought this policy. At that time, the S&P value was what? Let's try to see a real life example. We go to in.tradingview.com. You can also check this out. It is a very cool website for checking the stock based returns. So these are the indexes of India, Nifty 50, Sensex. This is S&P 500 we were talking about. Let's open this. If you are not from India, you don't have to type in dot. I think you can just simply type tradingview.com. It will pick your specific country based domain. So S&P 500 index. So right now the value is 4556. See this on a super chart. This is not a part of a course that we are doing, but I just wanted to show you that you can check this out from here as well about the returns that will be provided. So this is the chart in front of me. I can now see over here very carefully. Very carefully. So 2023, okay. This is, let's say, 1st of Jan. First of, yeah, 3rd Jan. So you can see the value is 3991, right? 3991. So let's say I will type over there. The S&P value is 3991. If you see, let's say, okay, the value is already at the all-time high. I am saying that I am going to provide you with the interest crediting occurs on a point-to-point basis. It refers to change in index at the two pre-selected points in time. We are saying that, okay, that those pre-selected points in time are on a yearly basis. That whatever with the return from 1st Jan to 31st of December, I am going to consider that differences between those two index values. So for example, let's say I am considering the 11 months, not even 12 months, just for the sake of simplicity. Let's say up to this point I am considering for the first only 10 months, right? So if you see the value at the end of 10 months is 4111. So I will type that on 31st of October, 30th or 31st. The value is 30th October 4110. 4110. Whereas if you see within that period, the value also shoot up to the 4603 as well, which was on in July, right? In July, the value was 4, you see over there, 4597. But I don't care. I am considering the return that is on a point to point basis between the 10 months. I'm just taking an example rather than a year example. I'm just taking the monthly, 10-month basis of example over here. So what will be the return I am achieving in this point of time? So that is 2.98%. So I am going to accumulate your balance. So this 2.98% will be over here. Basically, you can say this is 2.98%, right? And then 80% I am going to give you. So that will be 2.4%, and that is what you are getting. So that is what the meaning of interest crediting will occur on a point to point basis. So it can be on a daily basis, it can be on a monthly basis, half annually basis, or a annually basis. Although I have observed these interest crediting occurs on a daily basis. So which simply means that you are not going to lose the all time highs that you might have achieved. Make sense? Let's move forward. So your income payments will be tied to a specific stock index, for example, S&P 500. We are saying that there are three different types of investment strategies that will exist. So when we are saying this investment strategies, what we are trying to say over here is that the return you are going to get, the return you achieved on an index is 2.98%. But what return out of this balance I am providing you as an insurer, what I am providing you to the policyholder. So there are three different types we are talking about: cap rate strategy, participation rate strategy, interest rate spread strategy. What these three strategies are, we will cover later on in this session only. But just for now, this is a type of participation rate strategy. What these three strategies are, we will cover. Just hold on for next 5-10 minutes. Okay, next thing. You can also get a minimum guaranteed rate of return, but your upside potential is limited too, right? Because over here, so what we are trying to say over here is that minimum guaranteed rate of return. If you remember in FA, we are saying that, okay, we are going to give you a minimum accumulation of 2%. So over here, we can also say that the minimum guaranteed rate of return that you will achieve will be 0.01, let's say. So which means that even if the return is negative, right, you are still going to get at least the 1% rate of return which is guaranteed. That is what we are trying to say. Let's say guaranteed rate of return in this is 1%. So I will put this value over here like this. Make sense? That is what we are trying to say. But your upside potential is limited too, because of like it will happen in one of these strategies, or it can be said in general as well that, okay, the maximum accumulation that we will provide you is 10%. So you can say that you can apply one more condition where you are saying the that will be the maximum that will provide you, for example 10%, that if this interest accumulation will be higher than 10%, then we are going to provide you with the 10%. That is a cap. Next thing. So insurer invest your money into the different kind of indexes of your choice. You can select the single index like S&P 500, or you can pick multiple indexes, for example the combination of S&P 500, Russell 2000, Nasdaq 100. So I think these are mentioned over there as well. Mm, This is Nifty 50. It consists of 50 stocks which represent the Indian economy. Sensex, it contains I think 30 stocks. This is S&P 500. It contains 500 basket of stocks. Then this is Nasdaq 100. Okay, I think it is it. I'm not sure, but I think this Nasdaq is related to the technology related stocks. Okay, so that is, so if you see the components. Yeah, so you can see like what different 100 stocks that together becomes the Nasdaq 100 index. So you can see what are their current market price, USD, and all these things. So you can get, so you can select a single index or you can select a multiple index. Again, it offers tax advantages. The interest earned is tax deferred. You have to pay tax only when you withdraw it. So during the time of accumulation, no taxes will be charged, but it will be charged when you start withdrawing it. Same concept like fixed annuity, that You can get this amount as a lump sum. You can get this amount in the form of an annuity for the remaining lifetime, or in any way that you want, man. Okay. Next one, the minimum guarantee we discussed above. The commission to be paid on this product will be between 6 to 8%. So if you remember, in case of fixed annuity, the commission was between 1 to 3%, but over here it can be between 6 to 8%. You see, in a FA product, it was between 1 to 3. Over here, it will be between 6 to 8. Next is the fixed index annuity are going to invest your money in an equity market index, as we discussed over there. The mortality expense fees can be between 0.5% to 1.5%. The investment expense fees can be between 0.6% to 3%. What we are trying to say that the insurer is going to provide you with this index facility. So there will be the fund management charge, the investment management charge that will be occurred, right? For example, if you're not buying this kind of product, you are just a simple person who just invest your money into the equity market, simply no insurance product, no annuity product we are talking about. If you buy this index from your own broker, stock broker, you still have to pay the expense amount, the expense charge. Or if, for example, if you buy any kind of mutual fund, you have to pay the fund management fees. And if you buy any kind of Nasdaq 100 index and all these things, there are also tracking errors within that. So I will not go into that concept. What I will tell you for now, let's stick to the annuity side, that if the insurer is providing you with the facility of the equity market side, so there will be the fund management charges, investment management fees that will occur. So those expenses we are talking about over here. This mortality and expense fees is simply that, as the insurer will also provide you with the guaranteed, basically the death benefit during your accumulation phase. It's like a term insurance we covered earlier. So for that also there will be a charge that will occur. So this entire premium is not going to be accumulated technically. Okay, there will be the charges that will be deducted out of this balance. Make sense? So that is what we are trying to say. Even from this balance as well. That is what we are trying to say. You can say like premium, like even in the previous case, the fixed annuity, let's say um, say the let's say the person paid 100,000, but we deducted the 2,000, or basically the 2% out of this balance for our other charges, then the rest of the remaining balance will be keep on accumulating. Same you can say with this example as well. 95, let's say. But one sorry, but one key point to note over here is that this charge that will be deducted, it will not be deducted only for just one single year, it will be deducted every years out of this balance as well. Okay, that is because obviously if you see, like fund management charge, it will occur on the account value balance that exists for you. Okay, I'm not going to get into a lot of details right now with this cash flows concept, because that is something we will cover in our module when we will talk about the cash flow modeling. But just try to, showcase you a little bit of things, how things are moving in a graphical manner, you can say. Okay, so these are not the exact calculations, or not how exactly how this NVT system work, but from the understanding perspective we are learning right now. Because then when we will start with the cash flow modeling, then we will learn all these concepts in a lot of detail. So these are the charges that will be charged. Disadvantages can be that the gains are capped. We discussed lack of fee transparency, high sales commission. There will be surrender charges if the person, let's say, does not want to continue and wants to, let's say, withdraw at this point of time. There can be a surrender penalty which can be as high as 10%. Okay. So now let's discuss these three investment strategies that we were talking about. That was cap, participation, and interest rate spread. Cap rate strategy. It can be the maximum amount of interest that can be credited during a specific index term. If you remember, I used the example of 10%. So that is the same thing that they are saying. That whatever the return that will be generated by the index, it doesn't matter if that return is higher than 10%, then the interest accumulation will be only 10%. If it is 2%, then it will be 2%, 3, then 3, 4, or 4. But if it is 11, then you are going to get 10%. If it is 15, you are going to get 10%. If it is minus 5, you are going to get 0% because you are going to get a full principal protection. That is what we are trying to say. Next is the participation rate strategy. It is an upper limit percentage that can be used to calculate the interest that will be credited for a specific index term. What we are trying to say is this concept that whatever the return that will be generated by the index, there is a upper cap on the return that will be accumulated to you on that specific return, and that is in our example we are considering 80%. That whatever be the return, I am going to give you the 80% of that return as the interest accumulation. Okay, let's move further. Interest rate spread. Spread is a fixed percentage that is subtracted from the index growth before the interest is credited to the annuity. We are simply saying that whatever the return that will be generated, I am going to deduct, let's say, 2% out of that every single time, and then I will provide you with the return. For example, in this case, 12% is the return generated by the index. The insurer will accumulate 10%. If the 10% is generated by the index, insurer will give you 8%. Right? If the return generated by the index is 3%, the interest accumulation will be 1%. So every single time 2% will be deducted, it will be a part of interest rate spread. That is what we are trying to say. So these are the three different strategies that can exist. So in our example, we use the participation rate strategy. If I summarize this strategy concept, let's take a look with the help of an example. Give me a second. So let's say that, okay, as a cap rate, I am giving you the 4%. Okay, cap rate, I am giving you 4%. Participation rate, I am giving you 80%. And interest rate spread will be 2%. Interest rate spread will be, let's call it IRS. Interest rate spread will be 2%. External, let's say S&P 500. Now let's see what will happen. If the return generated by the S&P 500 is minus 1%, what will happen in this case? You are going to get a 0% return as the interest credited. If the return generated by the S&P 500 is 0%, same thing, doesn't matter. If the return generated by the index is 1%, now what will happen? In case of cap rate, you are going to get a full. In case of participation, you are going to get the 80%. So basically this into 0.8. Right? This will be the interest accumulated. Interest rate spread, that is 2% will be deducted by the insurer, but this return is only 1%. So your interest accumulation will be 0%. because I cannot type -1 over here. Basically 1 minus 2 is equal to -1, because I am going to get a full principal protection. So that will be 0%. Next year 2% return, you are going to get a 2%. Over here it will be 1.6, and over here again it will be 0, because 2 minus 2 is 0. But when it comes 3%, you are going to get a 3%. Over here you will get 2.4, basically 80% of 3%. Over here you are going to get this minus 2%, 1%. I will use just these two examples, then you will understand every single thing. What will happen in case of a 4%? Again, you will get a cap rate of 4, so you are going to get 4%. Over here 3.2%, because of 80% of this. 4 minus 2 is 2%, so that will be interest rate spread. Now, when the S&P will generate the return of more than 4%, in case of a cap rate strategy, you are going to get only 4% rate of return. Okay, so that is also one of the thing you can cover, like we have covered over here as well, that the upside potential is capped too, using the cap rate strategy, which in our example is 4%. So 4%, in case of a participation rate, it will be 4%, basically 80% of 5%. Then 5 minus 2% will be 3% based on that. So these are the different methods through which you can see how the interest is being accumulated to you. Okay, I can just show you with the help of the example over here as well. I mean, you can see over here that these are the returns that will be generated by the index, and then how it is being accumulated to your balance. And you can see everything is being capped at, I mean, below side, there is a full principal protection. But in case of cap rate, that is 4%, it is being, your upside potential is capped too. Okay, and this is interest rate spread. Basically for the first 2% rate of return, you are not going to get anything. So this is the return of our index at the x-axis. So you can see then after 2% it is going to grow. Make sense? So that is all we wanted to cover about the concept of fixed index annuity. So I hope that you all enjoyed this, and you can check out our other courses on actuaryscience.com. That is Python. We have covered in a lot of detail, and the SQL basics to advanced. Every single thing we have covered. So with this, I will see you in the next session. Thank you.